When I'm looking at the original consolidations, I'm looking for a repetitive overlapping or reoccurrence of a level that's being constantly referred back to inside of a consolidation. Now I'm anticipating the market to go higher, to go above the buy side here, and then reach up into this inefficiency up here. But I'm anticipating also that it should offer some measure of consolidation, because if it's going to do that, my premise behind swing trading is it's all on the basis of a market maker sell model or a market maker buy model. That's what swing trading is. Whether you realize it or not, whether you want to subscribe to it or not, that's what the market's doing. It's not doing harmonic stuff. It's not doing Elliott wave stuff. It's moving on the principles of running to liquidity, or it's running to inefficiencies. And if it's not doing that, it's consolidating. What you're looking for, what I'm looking for, is trades that make sense, where the market's reaching for liquidity, inefficiencies, and then reversing for the sake of going back against the original consolidation, where people are going to see this as a support level. And I don't trade support resistance. I attack support resistance. I attack liquidity above old highs. I attack liquidity below old lows. And I use inefficiencies as targets or means of entry to trade against those same ideas, which would be anti-retail theory. I'm against it. I'm opposed to retail theory. Anything retail. If it's support resistance, harmonic patterns, Elliott wave, Gann, Wyckoff, all that stuff, that's all retail logic. And my understanding is that's the reason why that 90% people that try to use all that stuff fail, and they fail rather quickly. You have to understand all the PD arrays. You have to be familiar with them, because what you may or may not realize is a market maker model is relying on your understanding of every PD array I've made available. So if you're looking at price, you're going to see things in price that are going to be salient to your understanding. If you don't know what a breaker is, if you don't know what a mitigation block is, if you don't know what an inversion fair value gap is, the observation of seeing it real time as a market maker buy or sell model may escape you at the time when you're looking at price action live. So one of the things I've seen throughout teaching this is that some of my students can see a market maker model really, really quick. And it's because they have been familiar with a multitude of PD arrays, not just simply an order block or a breaker. So they can see things and have a better understanding about price action. And that's what I mean by graduating in your understanding and not rushing this. Now, when I mentioned buy side and sell side, you're thinking liquidity. And I'm going to draw a distinction between the liquidity and the delivery. All right, so imagine, if you will, that you were looking at price and those relative equal highs right here that we're looking at conceptually. We would anticipate a run above that. Now, if you can get that far in your understanding from what I've taught, you have the beginning building blocks of understanding how to look for a market maker sell model. These conceptual ideas can be applied to it, okay? This whole idea from this run up to that level there, this is what I refer to as buy-side delivery, okay? So when price is running higher, it's offering buy-side. It's giving the marketplace buy-side as it's running higher. Now, for the purposes of running above this high and this high, it's running up to engage the liquidity that would be resting above these relative equal highs. So the distinction here is the directional movement when it's going higher, prices in a buy-side delivery. Liquidity above a single or a group of highs, that is buy-side liquidity. That's orders that are pending, whether to be a buyer to break out and go long or to protect a short position. So liquidity is a stagnant price level or levels where stops would reside. Buy-side delivery is the actual animated movement of price moving higher. And as you probably would have guessed, when we're looking at price going lower, this here is what I refer to as sell-side delivery. So the express purposes of running above these relative equal highs, that function has been performed. So now price could, if we're bearish, move lower and then trade back below the previous rally low. So we see the relative equal highs here with this high and this high here. And the market rallies up here. So all of this is the buy side delivery and then subsequent sell side delivery, attacking the sell side that was created after the run higher. And this run higher attacks the relative equal highs here where liquidity is. So markets go up for two primary reasons. One, it goes up to engage buy stops, which is buy side liquidity. Or it goes up to an inefficiency. What is that? Well, if you look right here, that's an inefficiency. We have this small little segment of price action where the previous candle's low stops here. The next candle opens, trades up a little bit, goes lower. The next candle we open, trade up, stop here, and then we move lower. This separation between these three candles here, one candle in the middle, this is what I call a fair value gap. It's a very specific price level that we look for, and it's one of the most visual things that you can see from our repertoire and the things I teach. Your eye should jump right to it when you see it. And in this case, if you've missed it, you can see clearly now it's highlighted. This one single candle went lower. So what does it need to do if it's going to be an efficient market? It needs to trade up back in between these two price points. This candle's low, this candle's high. We see that here. This candle trades up to it, but where does the close stop? Right at the high of it. The next candle, we open and we trade back down. Yes, there was a small wick here. Yes, there was a small little wick here. That is acceptable. That's permissible. But the bodies tell us the narrative. So all of this rally up here was under the pretense that we would see it just simply trade back to this little area here, above the buy side, above this high and this high. So ICT, how far can it go above these relative equal highs? You'd have to look to see if there's any close proximity inefficiencies. In this case, we have one right here. Notice this candle's tail goes way lower. Then we open, trade back up, making the low of the fair value gap. And then we trade here lower. Then the next candle we open went lower. So all of these three candles here, we've had a lot of back and forth price action. There's no fair value gap here. We can clearly see there's a gap because there's only one candle making that defined range of that low of that candle and that candle's high. So that small little area here is a fair value gap. The algorithm will go back to that and reprice to it. How? By going back up to it and offering a patch, filling in this only one singular down close candle. Here is a fair value gap. And where's the draw on liquidity? When you're using a market maker sell and buy model, you're looking at multiple draws on liquidity, and you have to be more nimble. So I'm saying this not to discourage you, but to remind you that it's going to take a whole lot more effort than you probably realize going into this. I've made available very, very simple, straightforward, elementary models using the concepts I've created. So if you get discouraged after this, just know that you can always revert back to the Silver Bullet or the 2022 or optimal trade entry models. They're very simple. So let's go into greater detail here, how the market ran up into this area here. Let's focus on how it went down, not just simply below the sell side of that original rally up, but it went down to this old low right here. Look real close, you'll see that it went just below that. That's not random. This right here is a buy side imbalance, sell side inefficiency. It's the opposite of this singular candle here. It's an up close candle. So it wouldn't be a SIBI, it would be a BISI, buy side imbalance, sell side inefficiency. So it digs into this just by a little bit, but specifically right below that low. And in here, we have that imbalance, and it trades where? Down. Once it gets into there, it reprices to the order block, then it rallies back up, creating the initial stage of what? A shift in market structure above this high here. So now we can look for a retracement back down in. So as it's retracing, we're anticipating the price doing what? Eventually reaching for the high here and here. So we can look for a lower time frame to give us a scenario where if we think it's going to go above these relative equal highs, and we can see that this fair value gap wasn't hiding, it's in plain view. liquidity highs here that are relatively equal, how far can it go above it? Well, looking over here, there's no inefficiency here, but there is one right there. So how far can it go above these relative equal highs? There. And look where the bodies stop. So now, does the market offer a consolidation? That's what we would be expecting here. Is it consolidating? Is it offering a small little pause in price where it goes sideways for a little while, which would be accumulating long positions? That's allowing smart money to accumulate longs. I'm going to zoom in. This is the same time frame, okay? So it's 15 minutes. Here's that low. You can see how we just went below it right here. See that? Here's that low inside the fair value gap with the order block, which is a down close candle. Again, we would be anticipating some measure of consolidation, not dropping lower, consolidation. Because that means we would be anticipating a run above the buy side here and the previous high that's to the left outside the scope of what I'm zoomed in on now, but you can see it's still being highlighted. And then that 60-minute fair value gap in the form of a sell side and bounce buy side efficiency, that's here. Okay. So what we're going to do is we're going to drop down to an even lower time frame and see if there's any more detail in here. So when we have a big decline, large range candle that's down, and then eventually, not like months later, not weeks later, but when it's a big drop and a handful of candlesticks like this, it's not a whole lot of candles, and eventually, rip back higher. That means that this was someone that's been caught. They're short, and they quickly reprice and leave them down there. So when I see that, I look to see where those two reference points are, where the market drops quickly for sell side delivery, and then when it rallies back up quickly, those one big candles down, one big candles up, all the price action below it, I would view that as trap traders. So that means by itself, that gives me narrative that it's probably going to go higher. The market rallies up. We have a down close candle that's just below this area right here. What does this up close candle become? Bullish breaker. Low, high, lower low. Down close candle inside of the breaker candle over here. That's a bullish order block right there. So when it rallies up and trades back down in, our target is what? Up here. Well, you have an opportunity to be a long entry here or a long entry there. So there's two setups. Which one of these, without going any further so far, which one of these would make sense for you as a trader right now with your present understanding? Obviously, it's a rhetorical question because I can't obviously get the response from you here. But I want you to think about that because I have some traders that would only be interested in taking this as their entry. And if they never get a return to the original consolidation, they're not long. Others want to see that, then it rallies, and in the next buying opportunity, as long as we don't get to the target up here, they're willing to take this as the first stage accumulation. And that's their entry. And then they ride it up into that target. I have other students that want to see it do this, then really prove it wants to go lower, and then they'll trade that one right there. And then go into that. That's a unicorn. Okay, unicorn is second stage redistribution in a sell model, market maker sell model. Now, when I say unicorn, meaning everything's in your favor, you got everything behind you. It's just so one-sided, and you can see it. It's usually the most energetic swing high that it drops down from. If you've classified everything correctly and everything to the left on the buy side of the curve is identified correctly, and you have everything labeled right, and you have time and price in agreement with you, chances are you're probably going to ride the lightning, which is really quick, sudden drops, and it's real fun to be in those low resistance liquidity runs. Now, on the left side is what? The sell side of the curve. That means we're in sell side delivery. What is sell side delivery going to be aiming for? The original consolidation low. Why? Because it wants to reprice under the original accumulation for sell side liquidity, the stops that are resting below here. For traders that rode this up, they're married to the idea it's going to the moon, Bitcoin 100,000, that type of mentality. Eventually it drops and goes and attacks them. Okay. So we went above the buy side here to a specific price point. we have a breaker. High, low, higher high, body staying inside of the PD array on the 60-minute. So it's indicating everything is there for this to start dropping, basically. If you notice here, I've said that the buy side of the curve used in reverse in the sell side of the curve, meaning what? This down close candle is a bullish order block. So while we were going up, when it drops back down into this, it should be offering what? Support. So when we get to the other side of the curve, which is to the right of this imaginary line, which is divided by the highest high, where we anticipate seeing the market reverse, on the right side of the curve, that's the sell side. So anything on the right side of the curve that was offered as support or as a discount array needs to start acting as what? A premium array or resistance. Rallies up. Right in here, we have an order block. Right there. And then we have what? It rips into the buy side, trading up into New York Open, 7 o'clock in the morning. There's your market reversal profile. Part of a market maker sell model. Time and price. Everything that was illustrated over here, now look what we're at. We're inside of the New York Open kill zone. We have a breaker. We have a bearish order block. All within what? The New York Open kill zone. This is also optimal trade entry.